Welcome to this screencast. It's a quick recap of ownership structures for GCSE business. And so we started with sole traders, and what you must know for your exam and the end of topic test to come is that they have unlimited liability, which means if something goes wrong with a business, a sole trader could be forced to sell their house in order to pay whatever they're liable for. And that's because they are unincorporated, so there is no difference in the eye of the law between the business itself and the owner of the business. Massive advantage, there is no paperwork needed to start trading. You can just arrange for a stall in the market and turn up and start selling and operating your business. One reason why there's no paperwork needed to start trading is that as there is no difference between you and the business in the eyes of the law, in the eyes of the government, then the government will come after you for income tax. And remember that income tax does rise reasonably quickly. I mean, £50,000 a year is a very good wage, but in terms of income for a business, it's not that high. So be aware of that. Next, we've done partnerships. So partnerships are still unincorporated, unlimited liability, no difference in the eye of the law between the owners and the business. The difference between partnerships and sole trader is that there is more than one owner. Between two, a minimum of two, and up to 20 in the UK. It's a very good ownership structure, works very well for professional jobs where by teaming up with someone just as good as you get the benefits of covering for each other when there is when you want to go on holiday or if there's some problem with illness. But not just that, also the benefits of sharing ideas, making the right business decisions with people just as qualified, just as experienced as you are. There is a little bit of paperwork before getting started, and that's to do the deeds of partnership where, by default partnership, every partner should be equal, but then the deed of partnership you can have junior partners, senior partners. Most importantly, you can decide how you would sell your partnership if it's time to retire. So that's an important decision process there. Remember that if an old partner retires and sells their partnership to someone new, because of unlimited liability, the existing partners would be liable for a mistake the new person would make. Something to bear in mind. Next, we've got private limited companies. So private limited companies is incorporated, which means the business exists as a separate legal entity than the owners. And that brings a lot of benefit, starting with limited liability. If a business goes bankrupt, the owners have lost their investment in time and money in the business, but they don't have to lose their personal assets to cover for the liability of a business. There is a minimum of 2 shareholders, sometimes we call them directors, in order to start a private limited company, which have to be registered with the government, and it's called Companies House in the UK. That's quite a small cost, around £100 in the UK. So the cost itself is not a barrier to establish a private limited company, but there is some paperwork involved. And also by the end of the year, some more paperwork, you have got to use a certified accountant that will certify the calculation how much profit the company has made. And this is very important for the government because the government will want to know the profit the business makes so as to serve it with how much tax on profit it's got to pay. Now, one important source of confusion when we're thinking about private limited company, what does private stand for? Private stands for the fact that to become an investor, it's private. It's by invitation only. Invitation from the existing investors. And if you watch the TV program Dragon's Den, you're actually witnessing this. You're actually witnessing these entrepreneurs. They've got their private limited company and they are pitching a share in the business for a lump sum to new investors by invitation. In year 11, you also will need to know public limited company. And public is because anyone can buy share in such a company. Anyone can buy share because they are traded in the stock exchange, LSE, London Stock Exchange. In order for these systems to work, you've got to publicize the detail of the yearly account, the financial account for the company. Nowadays, with the internet, it's quite simple to do that. But before the internet, public limited company, by law, any member of the public could write to them and request a copy of the account to be posted to them, and this would have had to happen, which means that it's quite expensive to set up and run such a company. By law, you must publicize, so there's quite a lot of scrutiny, and that is important so that the stock exchange can function reasonably well. So this public limited company, they are incorporated, limited liability for the owners. And if you're thinking in terms of starting a business, all the fairy tale stories you will hear about an entrepreneur who's made absolutely millions, that because their business eventually would have become public limited, and that's when you make a lot of money because the shares will be traded on the stock exchange. There is one other type of ownership that we will have to cover, but it's not in this video, and that will be franchising, but that works a little bit differently. Thank you for listening. I look forward to your answers in our exercise.